Whether you're just starting a portfolio or whether you're adding to an existing portfolio, the single best stock that I think you can buy today with $1,000 and just let it grow for decades is Spotify. Spotify is becoming the go-to platform for music, and then it's extending that position into being the number one company for podcasts, and also now moving into audiobooks. From a monetization standpoint, it has a massive premium streaming service where people are paying a monthly fee to access ad-free music and podcasts. And then they're also growing an advertising business that I think ultimately could be the profit driver in the future. So let's get into exactly what Spotify's business is and how quickly this company is growing, both on the top line and then on the bottom line and with free cash flow, because that's where I see the most bullish evidence for Spotify going forward. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they've got your top 10 stocks to buy right now. So let's just give an overview of Spotify overall as a company. And I'm going to start with just revenue and net income. You can see from this chart that revenue has been growing tremendously, 27% compound annual growth rate since 2016. That's the kind of growth rate any company would love to have. The problem is it hasn't led to net income for Spotify. I'm going to get to a few of these things in just a second. But the biggest reason is that Spotify doesn't have a really high margin business the way that a lot of software companies do. A lot of some software companies are going to generate 70, 80% gross margins on their revenue, because once you have your fixed costs where you're building out your product, you're paying engineers, product developers, then most of the money that you're generating for revenue is profit. Spotify, on the other hand, has to share about 70% of its revenue with the record labels. So that's why you have a little bit of a lower margin business for Spotify and just isn't as profitable. There are really two segments to analyze from Spotify from a business perspective. There is the premium business, which should be growing and relatively profitable. And then there's the advertising business. That gets a little bit more complicated because Spotify is still just trying to grow that business. It's not scaled yet. They're not doing a ton of personalization. They don't have the tools and market share to get a lot of those personalized as from an individual perspective, depending on both your preferences and also where you are in the world, the way that some of the other advertising platforms like Alphabet or Meta are doing right now. But they're moving in that direction. And I think ultimately that's one of the bullish cases for Spotify. But let's look first at the premium business. This is Spotify's premium revenue and gross profit since 2016. You can see that revenue has grown at a 27% compound rate, just about the same as revenue overall for the company, and gross profit has grown at a 38% compound rate. They're squeezing a little bit more margin out of this business than they previously were. That's showing a little bit of the pricing power that they have and the power that they have to negotiate with those record labels. The nice thing about this is the fixed cost that goes into building this streaming business, whether you're Spotify or Apple Music or Amazon Music, YouTube, all of the other competitors in this space, those are going to be relatively fixed. You have to have the technology and the capability to stream all of these services. And then as your user base grows, you're able to spread those fixed costs over a larger and larger group of people. So Spotify now number one position in music. So they're going to be able to spread those costs out over more people, likely generate a little bit higher margin than a lot of their competitors are in music anyways. Once you go over to the advertising business, the margin picture changes really quickly. You can see that there's a lot of revenue growth, 31% revenue growth. That's really solid. I would actually like that to pick up even more. I think this can be a $10 billion business or more within the next decade. So Spotify is getting there, but definitely not growing, I think, as quickly as they could. And they aren't generating much in the way of gross profit at all. When you pull out any operating expenses that you probably have with the advertising business, this is probably a money-losing business for Spotify. The other thing that they always include in advertising is their costs for podcasts. So this is when they sign these big contracts with somebody like Joe Rogan or the Obamas, those big checks come out of the potential gross margin from the advertising business. So that's another thing to keep in mind, is that we should see these margins improve over time. I'll get to some of these numbers in just a second as some of those costs roll off and they get a little bit more efficient on the podcast side of the business. This is also an area where they're going to have incremental revenue growth on the music side, but most of the music revenue is going to come from the premium side of the business, where I think the real opportunity to monetize from advertising is actually with podcasts. And that's where I think we're ultimately going to see a lot of the growth. This is why you want to measure podcasts on something more like hours listened or their market share and just see that growing over time. If they can do that, then I think ultimately this will be a profitable business, but we're not quite there yet for Spotify. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, layered into this is the audiobooks business, which is really just beginning for Spotify, but they're taking a little bit of a different approach from a lot of the other competitors. They're not trying to sell one-off books in the way that a lot of companies are. They're trying to bundle books with music and podcasts. They're including 15 hours of listening with some of their premium subscriptions, at least in certain countries, to see if that makes those subscriptions a little bit stickier and a little bit more valuable. If you think about what Amazon has done with their Prime subscription, now it's not just 2-day shipping, it's including video, it's including music, it's including all kinds of other things. So you want to sort of obfuscate the value that any given service is going to have. So think about music and also make the product more valuable to your customers. So maybe you lower your cost of goods sold from the music side of things, push from a little bit higher than a 30% margin, maybe up to 35% over a long period of time. And you're able to reduce churn and make this product more valuable by adding books to that bundle. So I think that's the theory there with both premium and with audiobooks. The challenge is that Spotify needs to get profitable. And one of the things that they have not done a good job until recently is keeping their operating costs relatively flat as their revenue grows. What you should see in a business like this is what's called operating leverage. So revenue grows 30%, but your costs only grow 5 or 10%, which means that more of that revenue is going to flow to the bottom line and become net income and free cash flow. We haven't seen that until recently, but let's look at some of those trends. I'll start quickly with the executive summary because I think this does put into context some of the growth that we've seen. A lot of the growth is coming from the user side, and a company that has 600 million users and is still growing at 20% year over year, that just shows the power that Spotify is building in their business. If they can get to 1 billion users, now you get to the point where is anybody really going to knock them off in streaming music, podcasts, and audiobooks? I think that would be a phenomenal position to be. So they're sort of moving into a more powerful position than they've ever been. That's one of the reasons I think you're seeing that margins start to expand. You're also starting to see free cash flow. Free cash flow has hovered around $200 million long term, and then it's gone negative periodically as some of their costs fluctuate, particularly coming out of the pandemic. One of the things that they did that a lot of tech companies did is their costs were going up, their operating costs were increasing, despite the fact that revenue stopped growing at the same pace. So that's why you see this negative number here. It's one of the reasons that free cash flow is moving up significantly. And I'm going to start with margins, and I'll show you those operating cost trends in just a second. Here's those margin numbers, and this is the premium side of the business in the middle, and you can see we're at 29.1% for the fourth quarter of 2023. Just slowly marching higher. Management thinks that they can get those up into the 30s. Even just squeezing another percentage point or two, I think would be a really solid move for the business. Where you want to see more improvement long term is going to be the ad-supported side of the business. This can get to 30, 40, 50%. That would be phenomenal tailwind for the bottom line. But right now, where we're seeing a lot of tailwinds is on the operating side. You can see that in the most recent quarter, total operating expenses were down 2% year over year. So we've stopped going from the point where operating expenses are growing. Now they're starting to actually go negative. That is on top of cost cuts that were put in place in December, 17% headcount reduction, which will likely take a couple of quarters to move its way through the system. So you have things like severance costs. There are other taxes and other strange costs that happen, particularly in Europe. So you're not going to see those costs. You're not going to see a lot of those savings hit in the first quarter of 2024. It's going to be more like the second or third quarter. So we should see those operating expenses come down as a percentage of revenue and even come down on an absolute basis, which is going to mean that more and more of that revenue and margin is going to flow to the bottom line. So you have tailwinds like margins increasing, operating costs going down. That should all help the most important metrics that we have for investors, which is net income and free cash flow. And here is a look at the free cash flow numbers. You can see this jump in Q4 2023. That's partly because of some of the operating cost expense reductions that they put in place in 2023, partly because of some free cash flow and increase in payables that they had. but that is something that's going to be recurring over time. So you do want to see this chart moving higher. It may be just a little bit bumpy like it's been in the past. So why is this the kind of company you want to just buy and hold for decades? Well, Spotify has a $46 billion market cap right now. It has a net cash position, meaning it doesn't have net debt on the balance sheet. That's a little bit over $2 billion that it has. So very safe from a balance sheet perspective. And then if you look at the operating trends, it's growing in all the right places. The user numbers are going up, more of those users becoming premium subscribers. And as the company improves advertising and increases the ad revenue that it can generate per user, you're going to get a tailwind from both more users and more revenue per user. At the same time, margins on both of those segments are starting to go up and operating costs are starting to go down. So you're going to see a ton of operating leverage in 2024. I think by the end of this year, Spotify is going to be able to generate up to $1 billion in free cash flow. So that would be an annualized rate of $4 billion per year for a company that has a $45 billion market cap and is growing revenue in excess of 20% per year. That's just a phenomenal position to be. And a company that can continue doing that over a long period of time is how you get to stocks that return 10x or more to investors. This is why this is the number one holding that I have in my portfolio. It's a stock that I continue to add to. And I think if you're investing $1,000 into just one stock right now, this would be absolutely at the top of my list. But what do you think about Spotify? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.